Thanks for joining this month's market update. I'm here today with Casey Lowe, Senior Consultant from Frontier Advisors, Capital Markets and Asset Allocation Team. Hi there, Casey.
Hello, Wayne.
Well, it's certainly been an interesting time for investors. Markets have been extremely volatile. Let's just start today with a bit of an update on exactly where we've been and where markets are at.
Of course, Wayne. So one thing investors and market hate more than bad news is uncertainty because, with bad news, they can price that, but it's a lot harder to price in uncertainty. And with the COVID-19 pandemic, there's been a lot of uncertainty. So if you look back in recent decades, we've had SARS, avian flu, swine flu, Zika, Ebola. But then nothing to the scale of the COVID-19 pandemic. You probably had to go as far back as the Spanish flu in 1918, which is more than 100 years ago, to get a sense of what's the impact. So, investors currently just don't know how to price this in. And what we've seen is that there's been a lot of panic selling since mid-February, where markets fell from peak levels by about 30 to 40% over a span of just 4 weeks. So it's been quite extraordinarily sharp fall. And you probably have to look back to the 1987 Black Monday crash to get something of a similar scale and sharpness in the fall, as you remember, Wayne.
I do remember that, Casey. I don't quite remember the Spanish flu, but the 87 crash I certainly do recall. Would it be fair to say that we've just seen a little bit of a rally from markets in the last few weeks?
Yes, so there has been a bit of rally. So since the markets have fallen by 30 to 40%, it has recovered a bit and it's about 20%, around 20% from its peak levels. So there's still a lot of uncertainty and unknowns with the COVID-19 pandemic in terms of the scale and duration and the impact of the virus. And of course, there's still the risk of secondary outbreaks occurring. But what's really driven the market rally has been two parts. The first part is that we have seen some initial signs of the curve flattening in key countries like the US and Europe. But the other big part is the amount of fiscal government support that we're seeing. So as much as the fall in the markets has been extraordinary, the level of policy support from authorities have been unprecedented. So to give you a sense of the scale of the support, some countries have provided support that's more than doubled what we've seen back during the global financial crisis. In fact, some of them are near levels that we haven't seen since wartime, back during World War II. So as example, Australia's stimulus to date amounts to about 10% of GDP. Now this compares to about 5% of GDP back during the global financial crisis. So it's very significant. While China, on the other hand, their stimulus to date has been about 3% of GDP. So they've taken quite more of a measured and disciplined approach to this so far.
Well, that certainly is significant support within Australia. But your point about China is an interesting one. Of course, an extremely important trading partner for Australia. So could you just elaborate a little bit more on what you're seeing in terms of policy support in China?
So there's a few things to note with China. The first thing is that they were the first in and first out of this pandemic. So for markets and investors, they may serve as a guide in terms of how long these containment measures will have to be in place before the virus is contained. Now, for China's case, they were in lockdown for 6 to 8 weeks before they started to loosen these measures. Now, this may be an optimistic scenario for some countries because China acted quite early and quite aggressively to contain this virus, while other countries may have delayed the response to date. So that's the first thing. The second thing is that since China has started to gradually loosen these measures, they have started to get people back to work. And looking at high frequency indicators such as coal consumptions at power plants for electricity generation, road traffic, rail traffic, and all of that, that suggests to us China's back to about 70 to 80% of the usual capacity. So not yet back at full capacity, but they are making progress towards that. So that's the second point. The third point is on the amount of stimulus that we're seeing today. So as I said earlier, it seems like China's taken quite a measured approach compared to other countries which have announced quite large stimulus. And it seems to be that the authorities in China are quite reluctant to put out big stimulus like we've seen back in 2008 and 2015, largely because of the issues it created afterwards within China. So I'm talking about the amount of debt it created from that, and also the excess capacity in industries as a result of it. So they're quite reluctant to do that this time around, it seems. And what does that mean for Australia? It means that we'll probably see more stimulus out of China, and some of the stimulus will likely be in infrastructure spending. So it will mean more demand for Australian iron ore and coal, so providing some support here for us. But most likely we won't see it to the same scale and extent as we saw back in 2008 and 2015 from China.
Okay. Thanks, Casey, for those insights. I know it's a busy time. You've got a lot to do, so back to work. But thanks also to you for watching this month's Market Update.